Hello everyone, my name is Shinta Amalina and today we are going to continue the sessions, the third session of Module 7 with the topic Stock Valuation. Section Goal: Student will understand how to value bonds and stock, while the module goals, student can explain return, risk and firm's value. So it is the chapter 7. The differences between debt and equity. First, the similitude: both are external financing sources, and the difference is that debt financing it is obtained from the creditors, such as the debt holders or the lenders, and they have a legal right to be repaid. It includes bond, and the payment will be based on fixed schedule. While equity financing, it is the external financing sources that obtained from the investor, who have the right as the owner, and they become the part of the firms. The owners only have an expectation of being repaid. So these both are external financing sources, but they have different treatment. Voice in management of equity as a stockholders. The first one is the claims on income and assets. When it comes to claim on income, they cannot be paid until the claims of all creditors have been satisfied. It also goes the same situations. The claims on asset, they are also counted as secondary to the claims of creditors. So they just get the leftover income and assets. The maturity, since it is a permanent financing, so they have no maturity and hence there's no required payment. The tax treatment: dividends payment is not treated as tax deductible for the firm's stockholders. Therefore, the cost of equity financing is higher than debt financing. So, there are two types of stock. The first one is common stock and the second one is preferred stock. What is the differences between common stockholders and preferred stockholders? Common stockholders is the true business owner of a corporation, and they receive the leftover claims after all other claims on the firm's incomes and assets have been satisfied. While the preferred stockholders, they are being prioritized and they get special treatment from the common stockholders. They receive fixed dividend periodically based on the par value preferred stock. Stock Common stockholders are also being assured for only one thing, is that what they have invested in the firms are the only thing they could have the proportions that they might lose. Hence, they are expecting higher return for these uncertain situations, and the returns might be as dividends, capital gains, or both. While the preferred stockholders, unlike the common stockholders who have uncertain proportion of returns, the preferred stockholders have fixed periodic dividend and they are senior to the common stockholder. Issuing common stock are several. Venture capital is the external equity financing provided by the investor that potentially has long-term or attractive prospect for a startup firms and small businesses. And when it goes to going public, they are like selling the firm stock to the primary market, and there are three alternatives. First one, public offering, they sell the shares to the general public. The second one is rights offering, they sell the new shares to the existing stockholders, while the private placement, they are selling the new securities directly to the investors. So now we are going to focus on the initial public offering or IPO. It is the first public sale of a firm's stock. It is like when they start from a small business and they goes bigger and bigger, and they require more capital, so they are going for this step as the initial public offering to expand their business. Common stock valuations. Common stockholders expect increasing share value, and some of the investors have certain motive for trading. So they have a trick to to share the value by spotting the undervalued shares so that they can sell that they think it will be overvalued. What does it mean for undervalued? is the current market price of share is lower than the true shares value, and once they get these undervalued shares, they will sell these shares in overvalue. That means the current market price of shares is greater than the true value. So here we comes for the basic common stock valuation, how to determine the value today of common stock. We can get D is the price dividend expected at the end of the year, while the R is the required return of common stock. There are three models by considering the growth. The first one is the zero growth model. It is the dividend valuation approach that assumes a non-growing dividend stream. So how to calculate is the dividend divided to required return. So example, Chuck Swimmer estimates that the dividend of Denham Company, an established textile producer, is expected to remain constant at $3 per share indefinitely. If his required return on its stock is 15%, the stock's value is $3 divided to 0.15, and they got $20 per share. And the second one is the constant growth model, dividend calculation approach that assumes dividend will grow at a constant rate, but a rate that is less than the required return. So how to get, we go with the same equation with before, but the required return should be deducted with the growth. So example, ABC stock paid a $10 dividend and it is expected to grow at 10% per year indefinitely. What would we be willing to pay if our required return on ABC stock is 15%? So here we got ABC stock paid a $10 dividend and it is expected to grow at $10 per year indefinitely. What would be we willing to pay if our required return on ABC stock is 15%? So here we calculate the dividend value first. So the beginning dividend is $10 and it grows to 10 times 10 times 1.10, and then we get $11 as the coming dividend. So here we just input 11 divided to 0.15, deduct with the growth 0.1. So at the end we got the value for $200 per share. The last is the variable growth model. It considers the shifting ups and downs of future growth rates due to changing business conditions. And here is the equations for the variable growth model. So it will be closed with a quiz. The question is, when the current market price of shares is lower than the true shares value, it is known as A. Overvalued shares, B. Extend valued shares, C. Undervalued shares, D. Minimum valued shares. So this is the end of this session today. Thank you for listening and watching. See you on the next session.